we're going to zoom out nearly 100 years and uncover what actually threatens your retirement. And it's not the crash that you're worried about. Most retirees think that one bad year in the stock market while they're retired, or maybe leading up to retirement, is going to ruin everything. That's a common theme out there, but unfortunately, the data really says otherwise.
When you look at the data and you look at the last 100 years, nearly 40% of market history has been spent in either declining or climbing back to a prior peak, right? A prior high in the market. This basically means that volatility isn't an anomaly. It's really kind of structural.
If a crash alone doesn't typically destroy a retirement plan, what does? This isn't about predicting the next market downturn. It's about understanding how markets really behave and how to build a retirement plan that survives reality, not the headlines. Welcome to the Retire Stronger podcast. I'm your host, Bill Kearney, and alongside me today for the 48th consecutive time, this is episode 48, as you will, is my co-host and co-founder of Crown Advisors, Mr. John Foard. John, would you say hello to everyone out there?
Helps if I turn the mic on, Bill. Hello, everyone. Nice to be here with you today again, Bill. And it's nice to have you opening up the episode for everybody.
I know. We got to see how this goes. This might be the first and only time this works if I don't do a good job. So we'll see how it goes from here. But all joking aside, kind of a serious topic today because it's something that we hear a lot when we're talking to people, when we're working with people. And it's this whole idea surrounding market crashes and how they actually threaten or maybe don't threaten your retirement. And we might be talking about long-term, out in the future retirement planning. But if you're someone who is in their 40s and is starting to maybe think about these sorts of things, retirement planning, income planning, how you're going to transition to retirement, this episode is absolutely for you. So be sure to stay tuned and listen all the way through. But I'll tell you that, starting out, most retirees think that one bad year in the stock market while they're retired, or maybe leading up to retirement, is going to ruin everything. And that's a common theme out there, but unfortunately, the data really says otherwise. In this particular episode, we're going to zoom out nearly 100 years and uncover what actually threatens your retirement. And it's not the crash that you're worried about. So we're going to zoom out. We're going to look at about 100 years worth of history. Should only take us 8 or 9 hours to go through this today. No, all kidding aside, we should be able to get through this in about 20 minutes. But we want to challenge 3 beliefs that are driving retirement decisions right now. First, that this rally, the current market rally that we're in, has been unusually strong. Second, this bull market is old and overdue for a crash. And third, one bad bear market can permanently ruin your retirement. And then we're going to answer one more important question. If a crash alone doesn't typically destroy a retirement plan, what does? This isn't about predicting the next market downturn. It's about understanding how markets really behave and how to build a retirement plan that survives reality, not the headlines. So John, why don't you take us through a journey of the last 100 years, a little perspective on the market so that we can get an idea of what our foundation looks like here.
Yeah, and Bill, I know that there was a recent article, I think it was put out by Morningstar, and I think we're going to drop that into the show notes for people as well. But, looking back over 100 years, it's not going to tell us exactly what's going to happen in the next 100 years. But I think it provides really good perspective on how the markets have behaved and what we've seen since 1926, which includes the 29 market crash, right? So I would tell you that when I looked at the data, and especially the article that we read through Morningstar, there were 3 standout recurring phases that we noticed. And the article mentions this, and it's great. But it talked about 3 main things: expansions, downturns, and recoveries. So when we're talking about this idea about, the 3 myths that we're going to be talking about and kind of what to do, you have to pay attention to what these expansions look like. And we define an expansion, folks, as what the market does after reclaiming a prior high. So an expansion is after the market gets back to the point where it was at its previous high, and then continues to move from there. Downturns. Well, what do we mean when we say a downturn, Bill? We mean a 20% or more decline in the market from a high. And then recoveries. Recoveries are that time frame from a low point back to a previous high. So that would be a recovery. So when you look at the data and you look at the last 100 years, it's crazy to think that we, we're talking about the last 100 years of market data, but nearly 40% of market history in this past 100-year data set has been spent in either declining or climbing back to a prior peak, right? A prior high in the market. And why is this important to note? Why are we even talking about it? I would say we talk about volatility with our clients a lot. And what we gathered, you and I, when we're talking through this, Bill, is that this basically means that volatility isn't an anomaly. It's really kind of structural in the markets, especially over the last 100 years. So the charts that we saw in the article, it kind of gives you a powerful perspective. And it kind of forces you to zoom out far enough to see that, chaos, if you want to label it that way, with volatility being dramatic, it's rather normal. Right, Bill? I mean, what would you say to that?
Well, yes. I mean, volatility and markets go hand in hand, right? And
absolutely.
I think for the experienced investor, that's not news. Even for the new investor, people generally know what they're getting into with the markets, that you're going to have volatility. In this life, you too shall have volatility, right? But I think that something people look at, if they zoom in too closely, in particular right now, is they look at this and they say, well, this current rally that we're in is way too strong. There's no way this can keep going the way it's going. It's gone up too fast. We're due for a major correction. And the answer to that is maybe. I mean, maybe that could happen. We're not here to tell you absolutes one way or the other. It's impossible to do that with the market. But I'm just going to give you some of the data, some of the history behind this idea of this rally is too strong. First of all, if you go back to 1926, 100 years, we have had 11 expansions over that period of time. The average expansion length was around 6 years. Yep. And the average return during those market expansions was around 21%. Now, let's look at our current market. Our current expansion is just over 2 years, right? Our annualized return is right around 21%, which is right in line with history. So looking back at September 2022, where we hit our low over this cycle, we're roughly up around 93% over that period of time. So if you annualize that, it's around 22.5%. So I think the key point here is that this rally feels abnormal because it's recent. There's a little recency bias going on here, not because it's statistically extreme. I think from an application standpoint, when investors label rallies too strong, what they're really saying is that I'm nervous. I think I'm going to move to cash. And in doing so, they might be moving to cash too early, right? Or they might make decisions to stop funding accounts because they have deemed a check mark in their mind that says it's time to dial it back a little bit. Or there may be reallocations of the portfolio emotionally. And I think that this sort of decision-making, when emotion starts to creep into our decision-making as it relates to the market, this can cause long-term damage in the portfolio, or at the very least, we're going to likely miss out on potential gains going forward because we don't really have a strategy. We just are kind of operating off of a feel. So just from the data standpoint, not a guarantee one way or the other, of course, this current rally is not too strong from a historical standpoint. John, I know that the other part of this that you're wanting to jump into here is that this bull market is old, right? This concept of, well, this has been going on for a few years now. This is old. It's time for things to change. What do you have to say to that?
Yeah, great point. And listen, too strong, man, give me more. I would love to see better returns, So I definitely agree with the data. as the data lays it out. And I definitely do not feel like it's too strong. But then there's the myth you just brought up, is this bull market is old, right? It's going on too long. We're overdue for a correction. So we get that question a lot. We hear it a lot. You might even hear it often on if you turn on the TV and listen to the talking heads. So, the reality though, when you look at the past 100 years of data, the average recovery alone takes around 3 years, and the average expansion lasts approximately 6 years. So from market low to the next peak historically averages around 9 years, which is interesting to think about. So right now in the cycle that we're in, we are not historically late in the cycle by that measure. So again, to your point a minute ago, I would agree with you. This does not mean that markets will continue upward uninterrupted. We have no way to predict that. We're not trying to make that assumption or that assertion either. It just means that per the data, market age should not be a tool that you should be looking at or using as a means of trying to time when you should be in the market or when you should be out of the market. So, I would also contend, Bill, to your point, to tack on to your points a minute ago, is you don't want to make adjustments to your income strategy just because a talking head on CNBC says the market is long in the tooth. What you should be making your adjustments, based on would be your income needs, or your time horizon, if your risk capacity changes, various other things we could talk through as to why you would make a change. But emotionally there's absolutely the wrong way to go about making changes in your strategy or your portfolio. Emotions can drive a lot of things, and it can hurt you long term. And I know you mentioned that a minute ago, but I know you wanted to talk about further. One of the things you mentioned earlier was like one bear market, it can ruin everything, and I know you had some thoughts on that.
Yeah, I do, John. And I, we're not here to say that bear markets don't hurt. We know that they hurt. We lived through 2008, along with a lot of the people probably listening here. And if you look at 2008, that was we were cranking along up to that point, but that one period erased around a decade's worth of gains. Some people were starting to call that the lost decade. And because the rolling 10-year averages turned negative. Once we hit that point. And that can be depressing. That is an emotional, it creates emotional strain and stress to think about those types of situations. But again, we're focusing on one data point of a market event and the penumbra around that event, right? We've got to look at the full picture if you want to be a long-term investor. And here's what that is. Over this 100-year period, our markets have spent 142 months in bear market territory. In addition, they've spent 349 months in recovery period. So roughly 40% of this 100 years, or 40 years of the 100 years, has been spent either falling or recovering. Yet we're still in a situation where if you were to look from 1926 till now, at the amount of income that was compounded, investment compounding over that period of time, it's tremendous. And
agreed.
I think that what you have to look at here is that the events of bear markets are going to happen. But the better question is, how is my portfolio going to be affected by this? Is it going to ruin my retirement? If it is, then structurally your portfolio probably isn't designed correctly. Because if you look at things like, okay, let's say that I've got a portfolio and a crash happens and I'm taking forced withdrawals from that portfolio. I don't have a liquidity buffer. I don't have any spending flexibility. That's going to create panic behavior inside of my portfolio.
Indeed.
There's a structural issue inside the portfolio where it's not designed to be able to withstand. It doesn't have the shock absorbers to withstand these bear markets that are going to come at some point during your retirement. And back up for just a second. If you listen to the way we're talking about this, we are not saying that a bear market isn't going to come or that a crash isn't going to happen at some point during this particular run that we're in. It could. We're hedging our language, if you listen to us, just like your portfolio needs to have hedged features inside of it for the what ifs, for the in case it doesn't work out the way data tells us or history tells us that it's going to, right? So these are some critical things to think about as a retiree. You don't need to just be along for the ride on the roller coaster here. There are things that you can do to actively prepare for when the rain comes, when the rainy days happen in the market, so that your entire portfolio isn't massively affected or destroyed because of a market crash. John, am I way off base here?
No, and I would tell you that kind of leads us to what we wanted to talk about next, which was kind of what real risks that you have in retirement, which you just started to kind of lead me right into that section, which is sequence and structure. And we truly believe as a firm and as advisors that this is where accumulation thinking breaks down for a lot of retirees and a lot of pre-retirees. Again, if you're over the age of 40 and you're starting to really look at your picture and starting to think about, when you might be able to retire, how you might be able to retire, this is important. And you need to be thinking about this. And if you're almost or about to ready to retire or already in it, there's still things you can do to help prevent a lot of this from happening to you or having this wreck your retirement income plan or structure. But, folks, you could have two retirees with the same average returns, but have a very different early sequence in their, in their returns or in their income situation, because, the one who experiences heavy losses early while withdrawing income faces far more pressure than the individual who does not have that happen to them. And what we're talking about there is sequence of return risk. So, the thing is, though, is like, Bill, solutions just aren't predictions. They're structural. So you want to have 2 to 3 years of liquidity for income needs. You want to have flexible withdrawal guardrails. You want to have diversified allocation aligned with your retirement stage, your goals, objectives, your risk tolerance or capacity for risk. And we've talked about this in previous episodes too. You want to have a written investment policy statement to reduce emotional decisions. And I'll go on record again right here, right now, that emotional decisions, and I think I was just quoted in an article on Market Watch recently, where I talked about emotions being one of the number one things that will derail your retirement income strategy. You have to be able to remove emotion from what you're doing. Folks, the goal isn't avoiding volatility. It's creating a proper structure in your portfolio allocation and your retirement plan to engineer around it. That should be what the goal is. And Bill, I don't know if you want to add anything to what I just said there, but feel free to jump in and add anything else you feel I might have missed or is important here.
Well, let's just give an example, right? Let's give a quick example here of what you are trying to explain. So let's say that you are set up and you're planning for retirement income, and you know that you're going to need $6,000 a month from your portfolio for spending expense needs in retirement. And I'm just throwing a number out there. Let's just say you have a $2 million investment portfolio and you need $6,000 a month. So that's $72,000 a year, right? What you could do is you could partition maybe a year, maybe 2 years, maybe 3 years. It depends on what you're comfortable with. But you could partition some funds that are invested in such a way where they are always available to switch to should the market decide to have a correction or have a crash. And if we isolate funds in this way, we essentially can switch on the faucet for those funds for a period of time, a year, 2 years, 3 years, whatever we've set it up to do. And then we can let the rest of the portfolio recover from whatever has happened to it on the other side. If you think of it this way, this allows you to structure the risk correctly inside the portfolio. while also allowing the large portion of the portfolio to be in a growth, or even, depending on your risk profile, an aggressive type strategy, so that you're not giving up the potential for gains on the vast majority of the portfolio. Just imagine that you could flip a switch and switch to the funds that are in the maybe the cash alternative environment, right? The hedged alternative environment.
Yeah, and what you're just describing there was what I kind of mentioned a minute ago, was creating guardrails. You're giving a perfect example of creating guardrails in your portfolio.
And you can quantify the guardrails. You can quantify the guardrails based on the income needs, right? And it creates a visual, and it creates the actual, okay, we're not going to wait for the event and then plan for what we're going to do next. We're going to plan before it happens so that we have a solution. And this is the criteria as to when we're going to switch to use those funds versus using the main portfolio. It's a great alternative way to think about this. But before I go too far down that rabbit trail, I do want to talk really quickly about what actually derails retirement and retirement portfolios. If what we're trying to get across here is that a crash alone doesn't ruin retirement, what does? And I would contend that what really ruins, or has the potential to ruin, a portfolio is behavior. Your behavior, our behavior as investors, right? Emotional behavior. For example, selling after declines, or sitting in cash too long, or trying to time your reentry. We've done numerous episodes here where we talk about how timing does not work inside portfolios, and how your best days of returns in the market are surrounded generally around your worst days of investing in the market, and how it's important essentially to be there for both of those. And then another one here is potentially overpaying for products that promise safety inside the portfolio. That can be an expensive endeavor. And I would say lastly, living in fear, right? And we have a number of folks, no matter what we do with them, they just don't want to spend the money they have in retirement, no matter how clear the road is. Hey, you're not going to run out of money. They're just not comfortable spending in retirement. This shouldn't be an example of, because you're worried about what the markets could possibly do, that you live in fear and you never spend and enjoy your retirement.
Agreed.
So we would say, look, if it works inside the plan, don't skip the trip. Don't skip the renovation. Spend time with the grandkids. Travel to see them. These are the things that you work hard to prepare for. And I think that the portfolio should be designed so that you can do these things and understand what the plan is going to be, what's going to happen when the market decides to take a dip. So, John, we threw a lot here in the last, say, 20, 21 minutes here. Let me just go over real quickly before you close us out what we covered today. All right. First of all, this particular rally that we're in right now is not historically abnormal, either from a length or from a return standpoint. Okay. This bull market is not historically old. Actually, it's relatively young from a historical standpoint in what we see. Bear markets are common and they are survivable. We also talked about how nearly 40% of market history has been involved in declines, or essentially expansions or recoveries, if you will. Volatility is the rule. It is not the exception. The greatest risk isn't the crash. Perhaps the greatest risk might be our behavior, our reaction to the crash. And I would say a 1A or 1B to that is abandoning your plan could be one of the greatest risks that you have as well. I think that we look at this and say that we do not build retirement plans assuming that there's going to be calm markets. We kind of look at retirement plans and build them assuming that there's going to be corrections, there's going to be volatility, because history guarantees that's what's going to happen.
I agree. 100%. Well said. And folks, if you're listening today and you're wondering, is my portfolio structured correctly? Or do I have proper income buffers? Or could I withstand a major downturn early in retirement? Or maybe you're sitting there thinking, am I being too cautious? Or maybe not cautious enough? That's exactly the work we do. Feel free to reach out to us. We offer a complimentary retirement strategy session. stress testing your allocations, aligning income, tax strategy, and even guardrails, feel free to give us a call, 704-469-0200, or go to our website at crownadvisorgroup.com, hit that complimentary assessment button, and find some time to get on our calendar for a quick chat to see if working with us makes sense to you. Or you can always email us at info@crownadvisorgroup.com. And folks, just remember, we can't predict markets, but we can prepare intelligently. History doesn't eliminate uncertainty, but it gives us context. And folks, context is exactly how you retire stronger. Bill Kearney, I'm John Foard. We'll see you on the next one. Thanks, folks.